Welcome back to the channel, everyone. Today I want to talk about how APE is causing absolute mayhem for the shorts, and how these shorts are still technically losing money overall on their short positions, even though the price of AMC has been falling, which should mean they're actually making money. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, you can see from this article from Illinois, USA, that AMC short sellers have actually lost over $1 billion in 2022, despite big stock price drops. Obviously, if these shorts are shorting AMC and the stock price drops, they should actually be making money. But overall net, when you include all of their costs, they're actually down over $1 billion. Illinois USA has obviously performed a calculation to compare the stock borrow costs, the MAYHEM FTD fees, and the margin loan costs against the profit these shorts have made from shorting AMC this year, and they've determined that shorts overall are actually still losing money. They've said as the first half of 2022 draws to a close, sellers betting against AMC have suffered big losses. So far in 2022, investors betting against AMC stock have lost $1.14 billion in 2022. One of the reasons these short sellers are still losing money on AMC, even though the price is falling, is due to the crazy cost to borrow fees on AMC, but also on APE as well. On AMC, the record high borrowing fee that we've seen over the last year and a half is 30% that was set recently on the 1st of September. Right now, today, as of the 6th of September, the fee is around 28%. As of this morning, it's 28.3%. However, if we compare this to APE, the fee for APE is a whopping 54.9%, which is significantly higher than the AMC cost to borrow fee and higher than AMC's all-time high fee as well. The reason why this fee is so high is because shares are so desperately hard to locate, because obviously there's not enough shares of APE that have been created. There's billions of AMC synthetics, but so far there's only 513 million shares of APE, pending any shares that have been created in APE so far by market makers like Citadel. Maybe Citadel have already created another 10 million, 20 million or 50 million APE synthetics, but it's not nearly enough to keep up with the number of AMC synthetics. Therefore, it's incredibly difficult for these short sellers to borrow APE shares to push the price down further, as there's not enough APE synthetics that have yet been created. Spencer's asked the question saying, why would there even be APE FTDs this early on into the stock's life? And he said very simply it was supposed to be distributed to identify the current shareholder base and how many company issued shares there actually are. If it was a one-to-one distribution to already identified current shareholders, there shouldn't be a single APE FTD, and every single share should have been delivered on time. He said a fail to deliver of the dividend to AMC shareholders could only happen if these shareholders actually hold synthetic AMC shares, or the brokers, the DTCC, or the market makers withheld the dividends on purpose to manipulate the stock on its launch. So what is it? Either international FTDs to rightful shareholders of AMC stock, or there's not enough APE shares to be delivered to all current AMC shareholders due to synthetics. Really, this APE distribution should have been very simple for Computershare and for the DTCC, and every APE shareholder should have received their one APE share for every one AMC share that they owned. But obviously the APE stock is already on the threshold securities list, it already has a whopping 55% cost to borrow fee, and there's tons and tons of shareholders that still don't have their APE, but yet there's a hedge fund that magically bought 25 million shares. As Nate said, we've still received zero explanation as to how an active short seller who works in Ken Griffin's building, known to manipulate companies in the past, was able to buy 20 million shares of APE. While yet many AMC owners have still not received anything, and the stock is already on the threshold securities list after only a week. APE is obviously causing absolute mayhem for the shorts, and the shorts are still losing money due to these exorbitant fees compared to the money they're making from shorting the stock. These fees are literally outweighing the money they're making from shorting, and these shorts are in real trouble. And guys, if you haven't already, be sure to sign up to Moomoo right now using the link in the description below. Moomoo is currently giving away a whopping 13 free shares, which is the most free shares that Moomoo has ever given away. Moomoo is very easy to use, it's incredibly customizable, they've got tons of technical indicators and advanced charting tools. From Moomoo's latest customer agreement, they officially state they do not sell your order flow to market makers like Citadel, and therefore Moomoo is brilliant for buying those AMC, those APE and those GameStop shares. On top of this, I also wanted to touch on the dark pool data for AMC and also on the S&P 500 and the QQQ or the Nasdaq. We can see here at the start of August, the shorts actually built a net long position in the dark pool, but over the last month they've been progressively shorting more and more shares of AMC through the dark pool. Their total net short position on AMC specifically is around $1.76 billion. In the past in March, and before this back in June of 2021 and January 2021, when these shorts build a large short position in the dark pool, it usually means they're in significant trouble and the price of AMC runs up shortly after. We can see here in March, the shorts had built a significant short position in the dark pool before at the end of March, the price ran up significantly. Right here in September, we can see the shorts are shorting more and more shares in the dark pool, which suggests to me that an AMC price run is just around the corner. But on top of this, if we filter the net dark pool short positions on the overall market from largest to smallest, we can see the shorts have actually built a $38 billion net short position on the QQQ or the Nasdaq. Basically, if you take away the short positions in the dark pool for the Nasdaq from the long positions in the dark pool on the Nasdaq, we can see there's a net position of $38 billion short on the Nasdaq. On top of this, if we look at the S&P 500, it has a net short position of $17.6 billion. Therefore, we can see that institutions are significantly short on the market, on the S&P 500 and on the Nasdaq, because they know a crash is coming. However, even though they've built a net short position in the dark pools, in the lit markets, their long position on the overall market is still well into the trillions. And therefore, when the market crashes, they will still lose billions, if not trillions of dollars as the market continues crashing. On top of this, Christoph has tweeted saying energy margin calls have been seen totaling at least $1.5 trillion. He said European energy trading risks grinding to a halt unless governments extend liquidity to cover margin calls of at least $1.5 trillion. Obviously, many of these same large hedge funds that are shorting AMC have been shorting energy prices, which has obviously skyrocketed over the last month or so. Right now, these shorts are obviously heavily underwater and they're currently being margin called for around $1.5 trillion. Therefore, Christoph is suggesting that governments need to step in and bail out these hedge funds with $1.5 trillion, or energy prices risk going insane. If these hedge funds are liquidated and $1.5 trillion worth of shorts are liquidated, it will cause a further squeeze in energy prices. This looks like it's the same kind of thing that happened with nickel when the price of nickel was halted as a result of a large Chinese investor being down billions. All of this crazy over-leveraged trading and investing that's being performed by the hedge funds just suggests to me how close the market crash really is. And as Lightning Warrior tweeted, he said they will try and call this the meme stock crash. The Federal Reserve already said last year that meme stocks pose a risk to financial stability, and therefore it wouldn't surprise me that when the final Hail Mary crash happens, which causes AMC and GameStop to squeeze, it wouldn't surprise me if the Federal Reserve try and blame the final Hail Mary crash on these meme stocks. They already set the playing field for this last year by saying that meme stocks pose a risk to financial stability, and therefore, when the market crashes and these meme stocks squeeze, it wouldn't surprise me if we end up receiving all of the blame. And that's why this user on Reddit said, can we preemptively coin this upcoming market crash the derivatives crash, so it doesn't become something stupid like the meme stock crash, to take away from the actual cause of it like the housing crash of 2008. Obviously, when the market does crash, the Federal Reserve and these major banks will be looking for somebody to pin the blame of the market crash on, and they obviously won't be blaming it on themselves. They're obviously not going to hold their hands up and say, guys, we're sorry for going massively over leveraged on the stock market. We promise not to do it again for another few years. They're obviously just going to blame the market crash on us retail investors continuing to hold our meme stocks and posing the risks to financial stability. But guys, be sure to let me know what you think down in the comments below. And as always, guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.